Saudi Arabia is reportedly shifting its strategy in the global oil market, moving away from its informal goal of maintaining oil prices near $100 per barrel. Instead, the kingdom is now focusing on regaining its market share. This change could lead to lower oil prices in the short term, but it aligns with Saudi Arabia's long-term goal of strengthening its influence on the global stage. Over the past year, oil prices have fallen by about 5%, despite OPEC Plus attempts to cut production and stabilize the market. A major factor behind this drop is the increased production by non-OPEC nations, especially the United States, as well as slower-than-expected demand from China. Saudi Arabia's approach is reminiscent of its strategy during the 2020 oil price war with Russia, when both nations flooded the market to protect their respective shares. This time, Saudi Arabia seems willing to accept the financial hit of lower prices. With significant financial reserves and alternative funding options, the kingdom is well prepared to weather the short-term impact of reduced oil revenues. By increasing oil production, Saudi Arabia hopes to regain a competitive edge, especially as OPEC Plus countries have seen their market share shrink to historic lows due to competition from producers like the US. So, what does this mean for the global market? Well, more oil supply is likely to drive prices down even further. This could benefit consumers and industries that rely on oil, but it poses challenges for high-cost producers like US shale companies, who may struggle to remain profitable with lower prices. Meanwhile, other oil-dependent nations like Russia and several OPEC members may face economic hardships as reduced oil revenues strain their national budgets. As this policy shift unfolds, we can expect continued volatility in oil prices. Much will depend on how other key players in the market respond and whether Saudi Arabia's move to prioritize market share will lead to longer-term stability or more disruption.